Well, good day, everyone. With yields compressing in the residential property market, if you're looking for some free cash flow or property assets to retire on, you're going to have to consider moving across to commercial real estate. I'm joined by Rethink's Son Pham, who's going to take me on a journey about how investors can consolidate their residential property portfolio and buy cash yielding assets in commercial real estate. And that's coming up on this week's Inside Residential Property.
Real stories, expert insights, smarter decisions.
With the banks, they are making it a little bit harder to borrow. Most recent one is the debt to income ratio policy. That's come back now. It doesn't mean you can't borrow. It just means, hey, we look at non-banks.
Property could essentially be a pretty powerful wealth tool if you stayed long enough in the game.
That's what I would recommend. Really understanding yourself in times, right, do I just buy myself another residential property? Yeah, it's going to grow X amount, but will it change my life? Is it going to really help me slow down on work? Probably not, because you need that income now to help you do what you need to do. What's interest rate today? 6%. Can I, weather a 9% interest rate? Repayment? Yes, I can. Okay, it's going to suck on my lifestyle, but hey, I'll suck it up and do it because I know that long term, this property is going to help me get to where I want to be with wealth creation. If you can afford to do it today, you just do it, because you know that in 2-3 years' time, those prices are going to go up. And it's just showed in the history of Australian property, it just keeps going up.
Tune in and find out.
Well, g'day everyone, it's Liam Garman, co-host of the Inside Residential Property podcast, and today we're going to be discussing something that I know is on everyone's minds. Now, if you've been in residential property investing for a while, you'll know that yields are compressing. You're not necessarily getting the bang on your buck through just residential property investing. So if you're looking for a bit of passive income, for a bit of cash flow, you're going to have to look across the water over to commercial property investing at some point throughout your investing career. But making that leap isn't as easy as it sounds. So today I am joined by the one and only, backed by popular demand on IRP, Son Pham, Rethink Financing Managing Director, to unpack this very important topic. Son, welcome back. It's been a few months since we had our last chat.
Thanks, Liam. So it's good to be back, mate. Always enjoy doing these podcasts. So yeah, happy to be back, mate.
Now, before we dive in, so the theme of today is moving into commercial property, but I think it'd be remiss of us not to chat about some of the big things going on in the world of finance and economics at the moment. Primarily, maybe some unpredictability with interest rates, with inflation going forward.
Correct.
What are we seeing in the world at the moment, and what's this going to mean for property investors in Australia?
Sure. So look, 6 months ago, we wouldn't probably think where we were today. I think 6 months ago, we were still on the trajectory of, lower interest rates. And then, come interest rate rise February, and there's been talk of another rate rise in May. Now you've got the war that's going on in Iran with America, just global turmoil, petrol prices gone back up. So there's a lot of instability. What does that mean for the property market, interest rates back in Australia? So I guess the market here has always been hot, still is. It's cooled off a little bit. And so the banks change policies all the time. And the most recent one is the debt to income ratio policy. That's come back now. Okay. So previously that wasn't a problem. Now it's back on the table. So what does that mean? It just means that with the banks, they are making it a little bit harder to borrow if you're over a certain DTI. It doesn't mean you can't borrow. It just means, hey, we look at non-banks as an alternative. So, it's because of the demand, the property price is still high. APRA, the regulators, they just want to try slow things down. Because, we don't want this crazy boom and then a crash. So it's always about just trying to have this nice a growth, I'd say. So, this is why I always say find a good broker, because you'll get banks tightening, but non-banks are always open for policy, open to play. Broker's job is to always navigate what lenders are out there to get you that loan for the next purchase. Property investors, are always a long-term game. We don't look at just what's happening today. Should I not buy today because of what's going on? No, we're always looking long-term. If you can afford to do it today, you just do it, because you know that in 2-3 years' time, those prices are going to go up. And it's just showed in the history of Australian property, it just keeps going up. So,
It is interesting looking back, like you highlighted 6 months ago, everyone was predicting those back-to-back rate cuts. And it was funny because we still, I think it's fair to say, historically are at a lower interest rate than, averages over the last 20 years. But just before we hit record, you and I were talking about the trimmed CPI, and I was looking a few months ago, and even a few months ago, I'm like, I don't think this is going to be a one and done rate hike. The things, the drivers that were contributing to higher inflation, housing, electricity prices, they're not going anywhere. These things are not going to come down. And ironically, some of those factors that were actually anchoring CPI lower, actually historically, well, not necessarily historically low, but abnormally low at this point. Petrol prices were actually dragging CPI down. So when you now have higher petrol prices, it's obviously going to drag it up, but then also all the flow on for food and everything else and the cost of goods. But that doesn't mean that borrowers don't have a way out. And so what you're saying is you do have alternatives out there, which are non-banks, which might offer that flexibility depending on where you are in your portfolio journey. Now, I've been over a few years of talking to you, Son. You've shown me some of the real benefits of the non-banks. When I talk to a lot of residential property investors, however, there is still a little bit of an apprehension because, everyone's so familiar with the big four in Australia. Everyone grew up with CBA over the last, 30, 40 years of their lives. They know the big brands. Some of the non-banks, maybe they're just unknown entities, which make people a little bit apprehensive. If you're a residential property investor, why is it worth your time to look at some of these alternative lenders to help you scale?
Yeah, because I guess you hit it right on the head, right? Like a lot of people just think a non-bank isn't safe, right? In Australia, lending is securitized, which means the bank will lend you money because they hold an asset, which is a house, property, right? So non-banks, banks, they all get funding in the same way, right? Government bonds, they go to private markets, wherever. They get money everywhere, right? And so at the end of the day, it's all secure. Now, and a classic example of what happened was during the GFC, right? GFC, you got some non-banks that did fold, right? It doesn't mean that you're going to lose your house, right? It's securitized. A trustee steps in, looks after the book, we call it, right? And then you know what happens? A major bank comes and gobbles it up anyway. And that loan becomes, the owner of CBA, whatever it may be. And that's what happened during the GFC. And then what the banks do is they jack the rates up anyway because, they jack the rates up to recover the cost that they spent on acquiring that business. So, we use a lot of non-banks. We use non-banks that have been in business for 30, 40 years. Some of the biggest non-banks in Australia. They're bigger than some banks. Not the big 4 or 5, let's call them, but they are bigger than some banks. And so, we look at those because they're going to help you buy that next property, help you grow your wealth. And, in time, this is why we always try to review and look at your situation. If your situation's better now, can we look at moving you back to a major bank or a bank in general with lower rates? Classic example like bonuses, etc. I've got clients who get a bonus and majority of the banks say, I want 2 years. Look, some of them are starting to do 1 year only. So I got one client who's just had a big 1 year bonus. Great, let's use that. Services, let's go back to a bank, etc. So you just got to be agile. You got to utilize what's out there. And so, when policies are tough like now it is with banks, you've got to look at non-bank alternatives.
And that's where when just before we started this podcast and you and I were rattling off a few non-banks that we've worked with, and I made the remark that I only recently found out that some of these weren't technically classified as banks because they were so big in their own right and in their own right have such flexible residential policy and lending that I think there are going to be a lot of people out there that might be frightened by the idea of it, but they don't even realize that they're necessarily using non-banks, which is critically important. And you highlighted, especially for self-employed people, for commercial lending as well, which ties in to our investor who is joining us today, Prue Bauer, who is joining us from Brisbane. Prue, welcome to the podcast. How are you going?
Awesome. Thanks for having me today.
And before we started, Vegas or Brisneyland? Are we going with Brisneyland for the sake of this?
Brisneyland. Let's be Brisneyland today.
Now, Prue, you've been investing for some time now. I've had a quick look through your portfolio and it looks that you're about 20 years into your investing journey. Can you take us right back to the beginning of what your property investing journey looked like and take us through the narrative?
Yeah, sure, Liam. Great question. I guess I started really investing in my early 30s, probably a little bit later than I should have. But first property being in Brisneyland on the south side with my partner at the time, and wasn't any lightning strategy, but plan was to, I guess, move into it, renovate it, flip it. Murphy's Law. The relationship ended before the renovation did, which is always a little bit problematic. So the profits disappeared a little bit earlier than anticipated. But I guess looking back on that experience, it did kind of get me hooked. And I guess for me, I realized that property could essentially be a pretty powerful wealth tool if you stayed long enough in the game.
Your career to date has spanned financial services, and you recently started your own business. How has that impacted the way that you perceive property investing, in particular as someone with your own business? What challenges has that thrown into the mix for your property investing journey?
Yeah, great question. I did spend the early echelons of my career in financial services. And recently, or in the last 7 years, I've been running my own business with my brother, which has a fairly significant manufacturing component in it. But I think for me, like, I've always really looked at property as a business in itself, thinking about risk, leverage, opportunity cost, and the strategy. But even for me, with a background in financial services, property investing can certainly teach you humility, because the markets and life don't always follow the plan accordingly. And, going into that realm of being self-employed, not in the PAYG, certainly threw up its own challenges, where having to look at potentially accepting much higher rates than you would if you're on that straight standard PAYG. So it's certainly been a journey in that sense.
So it might be a good chance to have a bit of a chat, especially for our listeners at home who are self-employed, that don't have that straight and narrow pathway for getting lending, for getting a mortgage. How does it look, and what are some tips and tricks that you can offer them to secure a loan?
Sure. So self-employed, I love self-employed because, there's so many ways to do loans for self-employed people. As always, I'm not going to give financial advice. I'm just going to talk from a lending perspective and what we see. Self-employed structures are very important. You got sole traders, you got company structures. They all have their own advantages, disadvantages when it comes to, say, lending, legal, tax implications. But what we see commonly is when you start out, you're a sole trader, which is fine, low cost to start up. But the issue with that is, as a sole trader, your income, all your personal stuff is kind of included as part of the business. So let's say, for example, you're a trader, you take out a loan for a car, asset finance on a car. Because you're a sole trader, technically we have to include that as part of your servicing, right? Whereas if that was in a company structure, we could ignore it, right? Some lenders will still want to look into that and expense it, but there are some lenders that just go, we don't care about that. The net profit at the end of the day is what we take, because the way we look at it is that asset finance, whatever it is, it's already paid for, and whatever's left over is net profit, and we can take that. So things like that is critical to whether you get the loan or not. In some cases, you might be at max tilt, and by just having certain things like asset finance, you might have 2, 3, 4 cars because you're a fairly big business. By having that hidden in the company and you've got the net profit, using the right lender, you can get further lending. So I guess, with self-employed people, that's structure is important, but also, again, if you haven't done your tax returns, that's okay as well. We do have the low doc option, accountant's declaration.
Can you define low doc?
Low doc is just a different form of documentation. So normally you'd have your 2 years tax returns, your personals, your business, whatever it may be. But a low doc is where we can use maybe an accountant's letter. So the accountant knows your financial position. We just haven't fully signed off on the tax return, but they know what you potentially earn. They just sign off on a letter, basically. Or if they don't want to do that, there's a BAS option. You can provide the last 4 BASs, which is 12 months, 1 year, and the lender can go off those, right? So there are different ways to provide documentation to the lender to assess.
Especially when it's quite complex if you're running your own business. Now, Prue, with that in mind, you've changed your career. You had some of the ups and downs, especially as you started your property acquisition and the renovation process. Can you give us a glimpse into what your portfolio looks like at the moment?
Yeah, that's a great question, Liam. It's certainly iterated and evolved and changed as my career's changed. Where it did consist of primarily residential for a period of time. Quite big proportions of that got dissolved or sold off. One, to put into the business and fund the business initially, because you need capital from somewhere. Manufacturing's not cheap in Australia. And so a lot of them did get sold off for the purpose of funding the business, which left me with largely a principal place of residence, which was pretty unencumbered, but so it had a lot of equity in it. And I then pivoted and bought a rooming house as well, because in the current climate, I was like, okay, well, this is good. It's got a better yield on it. And so I'm more likely to be positive rather than negative. The business was negative. I didn't need my assets and investments to be negative as well. So I had the rooming house sitting there. And then over the course of the last 2 to 3 years, I also used some of the funds from the sale of the residential properties to buy my first commercial property, which was a mix of retail and small offices.
Nice.
Fantastic. And that takes us to where we are today. Now, Prue, were there any major lessons on that journey that you'd like to flag for any of our listeners out there that are trying to move from that residential to the commercial phase?
Oh, so many, Liam. I think, I learned partnership matters, obviously, when you're doing things. And there's complexities that you don't always see up front. Like I had one property I thought was great. I'm going to do all these things to us, but then there were these heritage restrictions on, and being a bit eager to get going, I hadn't really checked much into that. So what I thought I could do versus, what I could actually do was really different on the purchase of that property. So look, I still made some money on it, but it wasn't anywhere near what I thought I was going to do. And I think that, having that liquidity really, really matters as well, to be able to move when you need it, but also just understanding more about, what can I do, what can't I do, and knowing the different options, particularly from a lending portfolio, and not like closing out my ability to continue to grow and evolve that portfolio, which can run into headaches so quickly if as Son was saying, you haven't got the structures right, you haven't looked at it properly, and you haven't had that great advice from those key professionals coming in.
Now, the residential property market's changed quite a lot over the last 20 years, and as has people's approach to it as well. And one thing that we've spoken a lot about on the Inside Residential Property podcast with the team at Rethink is, even today, investing in real estate today is not what it was necessarily 5 years ago. Some of those huge 20, 25% per annum returns that you've seen, especially in some of the smaller capitals, it's harder to come by now. So I'd love to get some insights, having made that switch into commercial. What were some of the resi assets that you bought that performed best? What was the asset type? What was the location, to share with some of our listeners?
Yeah, thanks, Liam. Yeah, good question. I think I've always tried to, be fairly much in my own backyard. Whether that serves me ongoing, I'm not too sure. But at the time, I guess it gave me a bit of peace of mind and security. So I was largely, in the areas that I was familiar with. So south side of Brisbane, whether it was Annerley, that Maruka belt, Yeronga as well, because they were areas that I'd grown up in. I knew them pretty well like the back of my hand, but also in my mind I was like, okay, well, these are pretty close proximity to the CBD. They had good infrastructure, good schools, good transport, so they seemed to make sense to me on on that basis. And Brisbane's certainly seen a lot of growth in the last 10 to 15 years. We used to be the old poor cousin, but now I think we're certainly moving up there, which is great to see. I think always houses for me as well. I think value being in land, it's such a scarcity. So I've never really gone towards that unit or townhouse market, but maybe that's my dad in the background going, there's only a limited amount of land and supply. So always very much been houses and fairly much on the south side. More recently, the southern end of the Gold Coast, but initially it was the south side of Brisbane.
Son, I can hear you agreeing.
Yes.
Emphatically.
Yes. No, Prue said it spot on in my opinion. Freehold is the way to go, I believe. House and land. Land is the improvements. Land is scarce. In time you can rezone, you can put apartment buildings, whatever on it. But not everyone can go straight into house and land freehold. So if you're a younger investor and you're limited on funds, just buy the apartment. They will grow as well. They're just a bit slower. Takes time. But yeah, if you can do house and land, definitely, as Prue has done, and she mentioned it previously that it's done well. So it's time when she started a business, she had to sell it. So residential can get you that growth that you need. But it sounds like now with Prue, it's more about the income. Your business was negative. She didn't want an asset to be negative as well, because when things are negative, it means you got to work so damn hard to funnel and feed everything, right? So I guess, this is why commercial can help you with that transition because of the cash flow that commercial provides.
Now, on that note, so Prue, you got to a stage in your resi investing that you were comfortable, you sold it off to move it into a higher yield asset. Can you talk us through what commercial asset you purchased, what the purchase price was, what the rough yield was at the time as well?
Yep, no problem at all. It was a bit of a baptism of fire because I hadn't done commercial before, but I've been watching Scott's podcast avidly, trying to learn as I go. I bought a mixed-use commercial building in Tweed Heads, so right on the border of Queensland and New South Wales, and it had in a street that was really starting to gentrify, or an area that was really starting to gentrify. There's also massive infrastructure and projects and developments going in around the area, but it was quite a niche street, Bay Street it was called, but it's got really interesting tenants, really good, I guess, variety of people coming through, but really up and coming, some great food going in there, different places. So it's got as I said, it's mixed use. So it's got 2 retail tenants at the bottom, and then it's got 9 smaller offices at the top. So I ended up buying that for 2.175 with a 50% discount on some building stuff that came through on building and pests. And it's got a pretty good yield. It grosses about 217 per annum. And after all costs, mortgage repayments, there's still close to 67, 70 grand left over. So just been doing some work on that in the last couple of weeks to clean up the leases, as we weren't really recovering 100% of the outgoings like we should have been, but looking at putting better lease terms in there as well, so we can get that extension on the whale, which is a new thing I've learnt about, moving from residential to commercial. So much better for financing, Son, so I hear, but it's due for review,
Yes.
so I might have to call you.
Now, there's 2 things that I'd love to get some insights into, because Prue mentioned it before, which I think is very reasonable. When you have that level of familiarity with residential property, making that you're diving into something simply that is an unknown when you're talking about commercial, the way that it's calculated essentially is quite different at the end of the day. Son, when investors start selling their residential assets, what factors should they be thinking about? Serviceability, tax implications, redeploying the capital. For people that are looking to follow Prue's journey, what should they keep in mind?
Yeah, very loaded question.
I gave you about 10 things in there. So.
But I guess, looking at Prue's situation, right? It sounded like, she knew what she was doing, but it's serviceability starts getting an issue. Cash flow was an issue. So she started to look at, what is commercial about with these yields and the cash flow. She's learning terms like the whale, and, good on Prue for really giving it a go.
Can you define the whale?
Whale. The whale is the average lease term, basically, weighted average lease expiry. So you got a commercial property that 3-year lease. That's 3 years term. We use the term whale when there's multiple tenancies. One's on 3, one's on 2, one's on 5. The whale is the average of all of them. And so, from a commercial aspect, commercial lenders enjoy that or like it when there's a longer lease in place, because for them it feels a bit more secure, less risk. The mixed use assets are pretty interesting ones, because you've got the residential aspect, which will give you stability, and then you've got the good cash flow. So, mixed use ones are good to get. They are harder to get in terms of finance as well, though, because depending on, what the allocation of resi is versus commercial, it could determine if it's been written as a resi loan or a commercial loan. Then you've got the holding asset, the holding entity, is it individual names, is it a company, is it a trust, what is it? So I think for the viewers out there, when is it the right time to kind of transition? I guess it really comes down to, first of all, what your goals are, what your financial goals are, okay? Because you'll get people who are very pro resi, some pro commercial. It's all about what you want, right? Some people are happy to play that negative gearing game. They run a higher income anyway. They're happy with all these tax deductions. I'm happy with the 5 resis that I've got and just let them grow, and in time I'll sell it. And then maybe I'll look at, commercial at that point. So what we see a lot of from where we sit is, the clients that are coming through wanting commercial is because they've hit serviceability. They want to keep going. They can't keep going with residential, so they want to look at commercial because it's got a high yield. They're looking at retiring. They want to receive more cash flow so they can dial back on work a bit, etc. Assets that don't perform, apartments, for example, it's done what it's done, but hey, maybe it's time now because I can afford to, if you do your numbers, right? Hence why you should sit with the professionals and just have your review and say, right, I got my apartment, it's made 200 grand. If I sell that now, minus any CGT, my costs, what do I get left over? Can I use that for my next asset? What does that look like? And if it buys me $1 million commercial property, this is the rent, this is the expense, where am I in terms of cash flow? Is that something I'm happy with? Then maybe that's time to do that. So it's a loaded question in the sense of when. It really depends on so many factors. Hence why I think sitting down with professionals, etc., and just mapping out what you want to do, what does it look like, do the projections, do the analysis, and see where you go from there.
Cool. Prue, on that note, given that there are a lot of considerations that you have to make when you're making that transition from residential to commercial, do you still have any uncertainties, any doubts, any maybe knowledge gaps following that move that Son might be able to cover off for you?
I think, look, you're always learning, right? If you stop learning, then fool's paradise, that one, because I don't know everything. I'm definitely trying to learn. Unfortunately, I've got a bit of background in financial services, but every sector I think has its nuances and its intricacies, and I think just the structuring as Som was talking about, or what type of loan, like what's the best thing to do here, and when do I actually need to look at changing this or altering this, and is it the best finance and structure given my long-term objective is replace my income, not have 20 properties that give me a headache and all the tenants that go along with it, but it's making me money, not costing me money, because I'm at a different age and stage than I was, in my 30s when I started. I'm 52 going on 53, and for me it's really about creating freedom, choices, options, and what is the best vehicle and mechanism to do that. And I just couldn't get the numbers to stack in resi, but commercial makes a lot more sense to me from where I'm at now, but I still got to work out how to do it properly because it's a shorter runway for me now.
Yeah, 100%. And to answer what Prue's talking about is, structure is very important. Yes, we haven't talked about it yet, but superannuation, self-managed super funds is probably the next chapter for Prue. Again, not giving financial advice, but superannuation is the most tax-effective vehicle in Australia. The Div 296 ruling just came out the other day or today or something. Anyways, we'll talk about that later.
We'll talk about that in a few minutes.
In a few minutes, talk about it a bit later. But essentially, again, tax effectiveness for Prue, inside super, it can be tax-free, right? There's a pension phase, we call it. So if she's got a commercial asset in there, and let's say she's paid off the debt there, she could receive that income tax-free.
Absolutely.
Right? So, if I was looking after Prue, first of all, I'd be understanding all of her assets, loans, structures, the business. I need to see it all. And then we can sit and talk about, right, where you want to be in 10 years' time. And then, setting it up correctly, structures. So if Prue still does have some residential that she wants to say offload, I'd say maybe offload and look at putting into super. There are limits on what we can put into super, so I can give her guidance on that and speak with accountants, financial planners to make sure it's right. But that's what I would do for Prue, basically. Yeah.
Now, Prue, before Son and I go off camera and start talking about your portfolio and providing some expert insights into it, what expert advice? I know that's the nervous part. What expert advice would you give your younger self if you were to speak to yourself 20 years ago and you started your property journey again?
Look, I probably wouldn't have moved to Sydney and worked in hospitality whilst completing my financial services. That could have been a slowdown on getting started. But definitely, I think, look, start as early as you can, but don't, I guess, take a passive seat, right? Like, learn, educate yourself. Always be in a room with people who are smarter than you, because it's the best way to learn, right? And it pushes you to grow and develop. But I think, really being very clear about where you're at, what the goals and objectives are, and where you're trying to get to. And revisiting that, because it does change over time, as we were saying before, like 30 versus 52, really different ballgame. So you need to have that flexibility and agility to be able to move through those phases in life and pivot and change.
And you do need that level of adaptability, because not everyone's life stages are not everyone's at the same life stage. What works for one investor that you hear about on a podcast might not be for everyone. So thank you so much for your time, Prue. And Son and I are going to have a little bit of a chat. Thank you.
Thank you. It's been a pleasure. Thanks for having me, guys.
I just want to add to that too. Like I have a saying, right? If you're not earning, you should be learning. Because if you learn, you'll earn.
Yeah, but that's very fair. Now, Son, for people that are in a similar position to Prue, that have built a residential property, that are looking to make the next steps, what financially should they be considering before, say, pulling that trigger?
Sure. So again, just sitting down and really understanding what you want, what your goals are, where you want to head. Prue's example was, cash flow, right? So, sit with the experts, find yourself a good broker, planner, accountant, and just map it all out together. Say, right, is this the right time for me to move into? I've hit serviceability walls, because I want to do this, like Prue, 52, we're going to look at next 10, 15 years retirement, right? Don't want to work as much, sell the business, and then get myself into investments, whether it's commercial, whatever, to provide me that cash flow. So that's what I would recommend, really understanding yourself in times, right, do I just buy myself another residential property? Yeah, it's going to grow X amount, but will it change my life? Is it going to really help me slow down on work? Probably not, because you need that income now to help you do what you need to do.
Now, we did highlight it earlier, but there is a changing lending environment that we're looking at. You've covered a few things, DTI, we've covered a few things, changing interest rates as well. Starting off at the very basics, how has the recent rate hikes and the recent rate movements, what's that meant for property investors?
Look, it's always, I call it noise, right? Rates will go up, down, left, right, center. Look, rates will always move, okay? What we have to focus on is what do we want to do? We want to create wealth, okay? And using property is a vehicle or whatever, right? So if you've got the means to do it, you do it, okay? The banks do factor in, 3% rises, etc. So if you want to do your own homework in the sense, right, what's the interest rate today? 6%. Can I, weather a 9% interest rate? Repayment? Yes, I can. Okay, it's going to suck on my lifestyle, but hey, I'll suck it up and do it because I know that long term, this property is going to help me get to where I want to be with wealth creation, right? So I actually like it when it's a bit difficult because I find it makes my job easier, to be honest. Because how so? Because as a broker, we have so many lenders to choose from. Client comes in, you look at the situation, you go, right, these guys are so good, I can go anywhere, right? And so if they can go anywhere, yes, we try to get the best rate, right? But then the ones that come in, it's like, DTI is a problem, right? I know straight away it just knocks out 5-6 lenders.
Yeah.
Don't even need to look at them. Great, I'll focus on the few that I have left. So I find that easier, And so for where I sit, like I can get a loan most of the time. I've got some interesting deals at the moment. It's never straightforward. I was just chatting to my BDM just before this. I said, do you think we can do this? And she's like, no.
Yeah.
Right? It's like, do you want to try? She's like, no. Because she knows that, what you've got there is just a flat no. But it doesn't mean I won't push, I won't prod, I won't try, right? And so, yeah, when you've got tough times like, I don't want to say tough times. I say when things are just a little bit interesting at the moment, we just navigate to other lenders that's on our panel that we know that will help you acquire this next asset. Whilst the interest rate is high, and let's say it's not quite meeting, your numbers, your projections of saying, oh, well, I wanted 50,000, I'm only going to get 40,000 now in net income. Just remember, it's just a little blimp right on the map because there are the 1% refi policies that you've got instead of looking at 3%. So I always say, navigate to this lender to get the loan, to get the property you want, and then just sit on it for a year or two. Hopefully it grows in value, rents rise, your income rises, and then you can look at refinancing it back to a mainstream lender with low rates in time. So what we see as a broker is we're always pivoting. It's never just set, here you go, and you have that loan for 15 years. It's never like that. I think the average loan gets refinanced every 3 years these days, right? So we constantly move around because everyone's situation is fluid, lifestyle changes, you have kids, career change, whatever. It changes the dynamic of everything that's going on. And so one loan that suited you then may not suit you now. I have an example where I've got a client who's got some good loans in Australia. He's recently, a year ago, he's gone over to America to work, high income. His usual broker can't help you. Okay, so he came to me and I looked into it. I said, well, I can help you. That lender can't help you.
Yeah.
Because their lender policy states this for you as an expat, right? But I can go here and do what you need. Great, let's do it. Looking at another acquisition, $1.5 million, right? So that's my job, right? To navigate for the borrowers out there for what they want to do.
And that's what we were very particular on the last show that we had to drive home, especially with so much chatter. And you termed it noise, which I think is a fantastic way of looking at it. A lot of the noise, especially in property investing circles about rate rises and what that might mean. Ultimately, rates are part of the equation, policies the bigger part of the equation and where you slot in. But also at the end of the day, it's a reframing of what residential property investing is, which is, yes, you can make a lot of money very quickly. And that does happen, especially over the last 7-8 years. It's happened more often than not. However, you do, as a property investor, have to remember you have to be in for the long game. Historically, property investing has been a 10, 20, 30-year game to actually see the results and achieve the results, which means you have to be in there for the long haul as well. You can't crash and burn out as a result of a 50 basis point rise. And if a 50 basis point rise is enough to put you in an economically or financially precarious position, not financial advice, but rethink where you're investing your money and rethink whether property investing is right for you. Because if $80 to $100 at the end of the month is going to put you into a tailspin, then this might not be the game for you. Now, we are moving into some certain unpredictability, and you said that part of your job is to find those outlets, find the solutions for your clients and people that you work with. If we are looking down the barrel of more rate rises, what are some tips, tricks that you can offer people that might be up against the wall in terms of their serviceability?
Yeah. So when we look at borrowers and their serviceability, their position, the biggest thing I look for is always savings, because I believe you should always have a savings buffer. I call that risk management.
Is there a specific figure?
There isn't. Look, putting my financial planning hat on, because I used to be a financial planner, you know, we as a financial planner, we look at, say, 3 months worth of expenses, right? It should be saved. The reason why 3 months is because usually we'd get clients income protection, 3-month wait. And so we'd have that sort of figure. Now, if a client had income protection that was a 30-day wait, we would say, right, maybe you only need 1 month's worth of cover, right? Saved up to cover your mortgages, your living expenses, education, whatever it may be. So everyone's situation is different. But essentially, you know, we would be looking at making sure that, as Prue an example, other borrowers, make sure you've got that savings. Because when we do serviceability and we see a client that doesn't have much savings, we kind of get nervous for them. Because you want to buy another property, that's fine. You've got the equity to do so, 100%, and serviceability says you could do it. But sometimes I still question that, because you say your expenses are blah, 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 but where are your savings, right? And if you've got 4 or 5, 6 properties, we get concerned, like, they're not always going to be hunky-dory. There's going to be issues where there's maintenance you got to fix, right? And so it's going to eat into that, okay? So that would be probably one of my trigger points for clients, making sure that they've got ample savings to mitigate some risk in case things happen, you can lose your job, etc. So that's probably the biggest thing.
And of course, you need that level of flexibility. Yeah, a redundancy or a partner taking time off work. Any of these things can be a huge, sometimes unforeseen consequence. And if you don't have that buffer there, it does put you in a very precarious situation. Again, you have to be in this, or at least prepared to be in this for the long haul. When Prue was online, you mentioned about transitioning into super. To start us off, you said Div 296. What's Div 296?
So it's a new tax the government's putting in place. It's for balances over $3 million. So balances between 3 and 10 is going to get extra tax, and above 10 is going to be more. Now, it sucks because it just means more tax as usual. But I guess, look, the good thing is not everyone's going to be hitting 3 mil per member. So let's say typical SMSF account, husband and wife, right? So it's essentially $6 million before you get that extra tax. Now, the extra tax is only an extra 15%. So right now, superannuation accumulation phase is 15% tax. In a pension phase is 0% tax. So essentially, previously, it was just 15% tax all the way up as high as you go in the accumulation phase. And so what we're seeing now is the government saying, right, once you exceed 3 million balances, we're just going to tax you additionally, right? Again, sucks, but it doesn't matter because it's still the most tax-effective vehicle in Australia. Now, if you had all these sort of assets outside of super, let's say individual name, whatever, and you had a return, and let's say your income is now from that investment $200,000 a year, you're on the highest rate of tax, right? So it's still a better transition, better structure, I should say, for people like Prue or people approaching retirement, and they want to have some sort of investment that's providing you with tax-free income. So as I was mentioning previously with Prue as well, you know, we all have super, we all work, we all get contributions being put in. It builds up over time. And just like borrowing in your individual name, you look at income. When you're doing serviceability for SMSF, it's very easy. It's literally just the contributions coming into the fund, the rent received, and any loans or any outgoings, etc. So to do that calculation, it's very simple. We can ignore everything outside of that entity, SMSF, and away you go. But again, it's always about the structure, the tax effectiveness of it, contributions going in, rents going in. You will pay down that asset quite quickly. So a residential asset in there we talk about is typically not positive, right? But what you will find is residential and SMSF can be close to being positive because you've got those contributions going in. You go to work, you get your 12% going in for your PAYG. You don't even see it.
Yeah.
You're earning $100,000 a year, call it a couple, that's 200. It's $24,000 going in, right, as you work, right? And then you've got the rent, that plus the contributions will cover, the loan, even at around 70% LVR, right? So
are there any LVR constraints in terms of borrowing through an SMSF?
it's very similar to outside.
Yep.
You can go to 80% for resi, even 90 in some cases. Some lenders can do 90. Commercials the same, go to 80. So the interesting thing is SMSF commercial, you can have a higher LVR compared to outside. And so what you'll find is, you can really pump that loan down. So when, say, Prue retires, she's got an asset that's tax-free, no debt, and let's say it's $1 million, it earns 6%, that's $60,000 a year. I mean, it's not bad.
Yeah.
The average, I think, if you look at the stats, are saying the average Australian in retirement will need around $60,000, $70,000.
How active an investor could you be through your SMSF? Are there any restrictions on buying and selling residential property if you were to have an eye to eventually build enough capital in there to retire with a commercial asset in your SMSF? How active can you be?
Yeah, look, it's a bit more restrictive with SMSF borrowing. It's more, I'd say, set and forget. The reason for that is because you can't really extract equity from that asset. So if you've got an SMSF and you've got resi or commercial, it's made $1 million, let's say, in growth, you can't utilize it, right? The only way to utilize it is you sell the asset inside, realize that gain, okay, and then you say split them up to two deposits and buy one and buy another one. Then you've got two properties instead of one. So it's a bit harder. But it doesn't mean you cannot do it. Okay, it just requires a bit more planning. So when we do SMSF, we typically like to do it as an interest-only structure to free up cash flow. So instead of paying down that loan, because when you pay down that loan, if you make extra repayments as well, you cannot redraw that.
Yes.
A loan outside you can redraw, you can't do this, right? So hence we like to say do interest only. Okay, utilize offsets if you want. Some lenders, can do it. But that cash flow, you could say, right, I'll invest it in some shares or something in the meantime. Now, if you invested some good shares that's got some good growth, there's your deposit as well. You sell that, pay a little bit of capital gain, not a lot because inside super is very low, and you use as your deposit for the next one. Okay, so you can be active. I would say it's just not as active, right? It's more of a set and forget sort of strategy.
Well, that is all we have time for today on the Inside Residential Property podcast. And I was joined by Son Pham, Rethink Financing Managing Director. And if you do want to get in touch with myself or any of the team at IRP, please reach out at liam.garman@momentummedia.com.au or reach out to the team at Rethink if you want to speak to Son about some of his financing solutions. Reach out to him and he would be more than happy to have a chat with you. That is all we have time for today. And until next time, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.